reports and also for your comment on our products. We commercialize an important database, and we are part of Megnoid Financial, which is a large financial conglomerate that owns also Standard & Poor's ratings and other companies. My focus of today's talk is based on a paper that I've recently carried out an analysis on the OTC derivatives market. And this was inspired by several conversations with academics and market practitioners particularly, and I would like to mention John Hall, particularly of the University of Toronto. And it focuses on the significant market changes that, okay, the point. I don't need it. You don't know? No, that's fine, okay, so I don't need it. That big focus on the new OTC derivatives reforms brought about by the Dodd-Frank in the United States and within Europe, and it is an international effort by regulator just to address the issue of financial stabilities created by OTC derivatives, and particularly by CDS derivative products, as Professor Altman mentioned before. So the goal is to review quickly, don't worry, I will stay within my 30 minutes, what are the major changes of this reform. And one particular, I would say, main takeaway that complements also the representation by Professor Brenner, who focused more on market risk and price volatility, is that the main takeaway, the main goal of regulators for this reform is to reduce, if not to eliminate, credit risk from these relevant markets. So the so-called counterparty risk. That was the main goal of the regulators. So the fact that OTC derivatives are not traded on electronic platform on trading values, but are bilaterally traded on a bespoke manner, exposes counterparty to a significant credit risk of the other counterparty. So it's very, thank you very much. This is very important. And then to reduce the risk of counterparty risk, that is credit risk for OTC derivatives products, the regulators are making all these changes that I will review today with you. Particularly, and I would say let's focus on the main points. Anyway, my attention is on the US and Europe because these are the regions of the world where these regulations have already been implemented, but also the Asian markets are following, they are lagging behind, but they will be implemented in the next year, this regulation. This also happened for Basel and for any similar regulatory efforts. Obviously, the US and Europe are the most, I would say, sophisticated financial markets in the world. That's where everything starts in those regions. The main point is to increase transparency, to impose central clearing on derivatives, to create electronification of these instruments, and fourth, to impose margins and capital requirements for unclear trades. All of these four goals are very related, and again, I would like to stress, the goals is simply one, to reduce credit risk within this important market. The figures that were mentioned by Professor Brendan before, these are very updated 2 months ago, April 2015, based on the latest figures from the BIS. So the outstanding amount is lower than the 700 trillion mentioned before, because there have been several changes, particularly due to Dodd-Frank and EMIR, but also due to the portfolio compressions netting that usually institutions are putting in place right now more and more frequently. So 680 trillion outstanding amount. Just to give you an idea, the 65 trillion is the outstanding amount on exchange trading derivatives, the products, futures and options mentioned by Professor Brenner. Obviously, these are outstanding amount. In terms of volumes, the exchange traded derivatives, futures and options dominate the OTC derivatives because when they trade, they don't trade so often because they are bespoke, and futures and options trade more frequently. However, The size of the market says that it's all about interest rate derivatives, swaps. Why? Because institutions usually buy, trade OTC derivatives to hedge interest rate risks in the banking book, in the trading book. That's the most important component. And then FX and credit derivatives. However, there is a big misconception on the CDS market. Many say this is a small market, 16 trillion now, not 30, but 16, no, it's decreasing more and more because of the, we'll see later, of the central clearing position. But the problem is that the CDS market is extremely relevant for any kind of OTC derivative product because it is used to price and calculate CVA, credit value adjustments, for accounting under IFRS 13 and GAAP, accounting principle, and also for capital requirements under Basel II. So, irrespective of having an interest rate and effects, there is always a counterparty risk. There is a market risk, which is the price of the exposure, the potential future exposure, how my exposure will evolve from now in the future, but it is also a second dimension, which is what happens in case of default of the counterparty, and then you need the CDS spreads or CDS proxy spreads to assess the expected loss of the OTC derivative product, which is called CVA. That's very important. And the situation is that of these products, obviously the regulators are prioritizing the ones to be part of this reform, and particularly interest rates and credit derivatives are the ones subject to Dodd-Frank and EGL. So that's very important point. Of the first of the four goals, the requirements, I would say, of this regulation, the transparency is the first one that has been implemented, and this is has been the key requirement in the market. Why is this important? Because as of today, or let's see, as of since this implementation of the transparency requirement, there were no prices, publicly available prices on OTC derivatives. Why? Because prices were only privately exchanged between counterparties. There are some data vendors like Standard & Poor's Capital IQ that collects data from trading desk and they create consensus prices. Other companies are Market, Bloomberg, but there were no prices. So the goal of regulators is to impose reporting to centralized databases, the so-called trade repositories or swap data repositories in the United States, to collect, aggregate data, and then disseminate back this data to market participants, right? And this is the first time that now we are having executed prices on OTC derivatives, which is a very important component for price transparency, price discovery, and for financial stability issues. We now know how and who's trading OTC derivatives and at which price, what are the bid and ask, and then it is a great complement that it is the major revolution in this market. In the table there, I just described some differences between this reporting requirement between the US and Europe. The difference is that in Europe the reporting involves also exchange traded derivatives like futures and options, as mentioned by Professor Brennan, but not in the United States. Another big difference is that in the United States, institutions need to report in real time whenever they trade derivatives to decentralized databases. While in Europe, the reporting frequency is only at the end of the day. So there are significant differences, but the underlying goal is still the same, to create transparency, not to increase, because there were no transparency before, just to create transparency from scratch on a very bespoke bilateral market to reduce credit risk. The second important requirement, which is related to the first one, is that the standardized OTC derivatives, that is the ones who are more liquid than others, must be centrally cleared. So they must be cleared by clearing houses, and this is something that we have seen already between broker dealers. Large dealers, they usually use clearing houses. to clear their trades. But now this requirement has been imposed to all firms in the world. What does that mean? Central clearing means that when firms trade OTC derivatives, they have now to post margin. So, which means they have to collateralize their OTC derivative exposure, which will have a big impact on credit risk, because the more collateral you post, the less credit risk you have, right? Because the probability of default could stay high, but if you have more collateralization, it's like having a much smaller expected loss. You are increasing the LGD. So in the United States, the central clearing has been implemented already in 2013. In Europe, unfortunately, the situation is far behind from being implemented. In Asia, even more behind. And this is one of the frustrating things of this regulatory effort, because the idea was to have a global intervention in the markets, but the situation is that these regulatory interventions are now fragmented, with the US going much faster than Europe, and Europe finding an agreement between all the different countries in the European Union to come up with a central clearing. While central clearing is lower than the US, in Europe, because if implemented, the firms will have to post collaterals, which mean posting security, and that will have a big impact on their liquidity. What is very important on this central clearing is that, based on the Financial Stability Board, they are expecting that almost 80% of the interest rate derivatives will be centrally cleared, which means that they will be very liquid to be cleared, and 50% of the CDS market as well to be centrally cleared. The major implication from a research point of view, you are academics, I'm a practitioner now, but I've been an academic for a while, is that anyway there has been an enormous amount of research, of efforts from quants to assess the credit risk, counterparty risk of these products, CVA, DVA, whatever it is. But now the situation is that if 80% of the market for derivatives and 50% of credit derivatives will be cleared, there is no need anymore to come up with quantitative modeling for this, because the risk is shifting now from institutions, from banks particularly, first, to central clearing houses, right? To central counterparties. These institutions will have the task of assessing and quantifying all the counterparty risks of the market participants altogether. So risk is still there, but will be in the hands of the central clearing house, the central counterparties, and no longer in the hands of banks and firms, and particularly banks that are obviously the most specialized institutions in the world on this particular risk.
Cristiano, what's the time frame of this expectation of 80% interest rate and...
this is related to the full implementation worldwide. So now, if Europe, the implementation will be taking place next year, and in Asia in the next 4 or 5 years. This is, I would say, the don't specify that for me is a 10-year forecast, right? In 10 years we're going to have anyway a very clear situation of how much of the markets will be centrally cleared or not. Simply because the original dates of the implementation are changing every day. So in Europe particularly, there is a strong difficulty in finding a political agreement between countries on clearing, because the impact of liquidity from margins also collides with the liquidity requirements of Basel III from banks. So there's not so much liquidity, right? And also, particularly, many countries, many banks in Europe are struggling with the sovereign debt crisis. And then there are issues in posting, for example, collaterals on Italian treasury bonds, or French or Greek bonds. So there is a big issue of liquidity that regulators are addressing, and that's why they are postponing their implementation. This is the situation in Europe. Very recent, they the latest update is on May 11, so just one month ago, and they are still considering what to be, the process to be clear. Now the focus that we're going to have a first wave expected in April 2016, so we had a meeting with the European Commissioner recently, Lord Hill, in London, and that's his goal, but will be only focused on interest rate derivatives and not on CDS. So CDS will be implemented later, so down the road, due to, again, disagreements between the countries on this specific asset class. So we're going to have, still for a while, a very fragmented situation, in at least between Europe and the US, in terms of what are the products to be cleared or not. And there are some risk of shifting for this market from one region to another, depending on the different requirements on these markets. Institutions are already moving sometimes the business in regions that are less regulated compared to the ones that are more restricted, due to the different, in a way, implementation phases between Europe and the US. As you can see also, there is a phased approach based on the kind of counterparty. So they will start with the broker dealers, and then we move down to financial institutions by side, but also pension funds, and also to corporates. So also non-financial corporates will be involved in this OTC derivatives reform, which is super important. Why? Because non-financial corporates are heavy users of OTC derivatives. For what purposes? Not to speculate, but for hedging interest rate risk, FX if they export, commodity risk if they're in a commodity market, and also CDS because they have to calculate CVA for accounting purposes if they are listed. So these will have major implications in the market. It will be very difficult from now on to speculate using derivatives unless you have a lot of liquidity and a huge capital base to withstand the very conservative, punitive margin requirements and capital requirements imposed by Basel. So it will be very, very difficult to open a naked position compared to the past, where uncollateralized OTC derivatives were accepted as a standard in the market. Electronification is another dimension. So once the OTC derivatives are going to be reported, creating transparency, they will have then, some of them will have to be centrally cleared. And for the ones who will have to be centrally cleared, there is also a specific requirement on trading on electronic platform. That's another very important point, because central clearing doesn't mean they have to be trading on electronic platform. This relates to the fact that, again, voice trading, voice messaging trading was the norm in this OTC derivative market. So simply traders exchanges prices over the phone, over messages, Bloomberg messaging, whatever it is, but not on electronic platform. So the transparency is and was and is still very low. This contributes to a much higher bid-ask spreads, and then also less liquidity. So this is a very important component. Situation here again is that in the United States the electronification has been already implemented in 2014 for interest rate and CDS. So there are some electronic venues where these instruments must be traded, and also others on a voluntary basis. In Europe the intention was good, but in practice we are still lagging behind, because electronification in the US is regulated by Dodd-Frank. In Europe is regulated by MiFID II, which is another regulation on the financial institutions and their offering to the market, which is different from EMIR. So it's a little bit, again, patchy I would say, organizational regulatory effort around OTC derivatives, and again, the electronification should be, as of today, be implemented in 2017, which means 3 years later than the United States. And there could be also some additional postponements if central clearing is going to be postponed as well. So these two are obviously related. The main point of Europe is that in the United States the electronification relates only to OTC derivatives, while in Europe the the goal is more ambitious. They want to create an electronic platform not only for OTC derivatives but also for all the other non-equity asset classes, for bonds, for structured products, again, to create a more transparent and liquid world on any asset classes. As you know, MiFID II introduced already electronic platform for equities, the so-called multi-trading facilities, and now they are going to introduce the so-called organized trading facilities, which are the equivalent of SEFs in the United States, but with the extension of the other asset classes. And since this project is very ambitious, I doubt that those days anyway will be likely to be kept as written. So they are not definitely set in stones, I would say. Margin is the last component of this story. So again, the goal is to reduce or eliminate the risk. So if the instruments are standardized and liquid enough, they must be cleared and traded on electronic platform. If they are not, there is not any free lunch. So the uncollateralized OTC derivatives trading that we are seeing now will disappear completely. Why? Because regulators are introducing also margin capital requirements, very punitive, very conservative, on all OTC derivatives that will be bespoke, bilateral. You want to continue trading a very bespoke bilateral between you and another counterparty, you can do it. You need to pay to post margin, initial margin, variation margin, and then the price changes, and additionally more capital requirement if you are a bank because of Basel III. But also if you are not a bank, you need to be obviously concerned about it, because banks are the major traders, the major market makers in the market, and they're usually the counterparty of a firm. If a bank is paying more capital for bespoke OTC derivatives trading, they are going to pass on the cost to non-financial firms. So also financial firms, non-financial firms are going to be impacted by by Basel III and by this rule. Very recent update as well. So the market for OTC derivatives for the clear one will be in theory 400 trillion, while the rest will be 200 trillion based on the recent estimates. So it's still a big market, but the point is that will it survive under this new condition? That's a big if, because the cost of trading bilateral derivatives will be very high. The update of March 18th, 2015, so Basel and IOSCO, the two organizations in charge of banking and securities regulation, issued their final proposal. So margins have been already defined. Any OTC derivative traders needs to have an initial margin at the beginning of the trade based on a value to risk calculation, 99% confidence level, 10-day value. So super expensive. And additionally, they need to post variation margin when there are movements in the pricing of derivatives. Implementation, September the 1st, 2016. This is a global regulation, global proposal that will have to be implemented by Dodd-Frank in the US and by Yale in the United States. So this is a very important piece, because now if you are trading OTC derivatives in a bespoke manner, you don't have to care anymore about the credit risk of the counterparty, because you need to post margin, initial variation margin, and then the expected loss will be very close to zero. And that's the original goal. There still will be a credit risk left, a CVA left, there could be a mismatch between the exposure and the expected loss, and the margin and the initial variation margin, but will still be minimal, right? The only risk could be the risk in terms of valuation of the collateral posted. So if I post an Italian treasury bond, maybe that could be much less in value in the future if the situation of the country will be different from that of today. But in principle, the uncollateralized market will disappear completely, which is not good for people engaged in credit risk, but could be good because of the way now the attention is focused on helping the clearing houses, the central counterparties, that are now the real managers of credit risk globally. They are exposed to a significant systemic risk, and you know what? They have expertise and experience only on market risk, but not on credit risk. So we talk with a lot of them, and they're not necessarily equipped with all the expertise and the experience on this space. And this is still a little bit a negative effect of this regulation, where the credit risk is moving from banks, who are the best in the world and they know how to assess credit, to central counterparties who don't have any clue on how to do it. However, the regulators say that there are different lines of defense in terms of margin and collateralization and capital requirements, but still, credit risk will be a dimension which will appear for sure if one of the counterparties could have a default in the future.
What's your speculation as to the impact of the margin requirement on the volume of these derivatives?
That's a very big question, and essentially, so there are, first of all, initially there should be negative impact, because the more margin, the less obviously liquidity, and this already, there is evidence on it, right? So the problem is that will the participants react aggressively, or at the moment are there some expectations of changing of the rules in the future, so some alleviation of the rules? This is not very clear, but I think in a way the impact on liquidity could be initially in a way negative, right? Because in a way that would eliminate all the advantages of this uncollateralized market that the participants have seen up to now. On another side, however, there are possibilities of having increasing liquidity and volume, because these instruments are going to be traded on an electronic platform, right? And then if the platform are the right place to trade, that could be a possibility of having also the involvement of algo traders, the buy-side institutions, who have been usually outside of this market that has been dominated primarily by large banks institutions. The point is that one of the major implications is particularly for non-financial firms. Right? There is a big risk for small non-financial firms to avoid hedging risk, simply because it's very expensive to post margin, both if they are cleared or they are trading unclear products. And that's a risk that sometimes we see. Some non-financial firms are deciding not to hedge in some cases, because the impact on liquidity of the margins appears to be very high. In closing, I would say one word on the futurization of the market, and essentially this word means that the market will go through a very significant electronification process, right? So the regulators want to have OTC derivatives to be traded on an electronic platform, to be monitored and controlled in a better way. Is this happening or not? Not yet, because there are, as I mentioned before, some issues in terms of implementation. But still, I think in a way that the OTC derivative, the bespoke market, will survive, because these instruments are the only ones who are now found to hedge properly very bespoke risks in very little standardized conditions. So the futures and the standardized products are very conditioned on the terms and conditions. So if you want to have flexibility in properly hedging your exposures, bespoke OTC derivatives are still, will be still the right products to trade in the market. Thanks very much for your attention.
Thank you.